Why would inflation rise once the pandemic is over? It's a question that's been boggling a lot of people's minds. Financial market signals of the deflationary pressure and consequences of the pandemic are expected to reduce. Hence, it is expected that the inflationary pressure are making a comeback. Looking at 2020 economy, the yield curve, the spread between the T-bond, the Treasury bond, and the Treasury bills have been downward sloping, and there has been an expectation of a recessionary environment. The spread has been rising ever since, as of March, and is expected to climb. However, the gold prices have been rising during the pandemic up until August, and it's been declining slightly ever since. The economy is expected to make a comeback. However, the stock markets have been making a comeback much quicker than the economy. Looking at the inflation and the CPI historically, it is evident that the inflation rate had started soaring in the 1970s and 80s. In the early 80s, there might have been a tightening monetary policy during the late 70s and the 80s. It might have kept the lid on inflation's spiral, but evidently it led to a severe recession. Based on the lessons learned from the history, inflation has remained low during peace times and has remained elevated during hardship and war times. Peace has led to trade and capital flows, which has led to globalization, which has led to competition in a deflationary environment. Technology and innovation have boosted productivity and has kept the lid on inflation. With lower fertility rate and an aging population, which aging population profile has led to deflation, and finally an easy monetary condition with respect to the credit markets and easy credit conditions allowing companies to raise debt at more favorable rates has led to a deflationary environment because companies that are going on the verge of bankruptcy can hardly service their debt, called zombies, would continue to raise debt and remain in business, adding to the global goods and services. With the pandemic in the 2020, Feds kept purchasing treasuries, and federal deficit kept rising, and when an empty money supply have been increasing significantly. Interest rates have remained low, exceptionally low, and companies have accumulated a significant amount of debt. However, as we see here, inflation has remained low. So we're going to go to the financial markets and look at the signals that the financial markets are giving us with respect to the inflation. The first signal is the proxy for expected 10-year inflation rate. It is the spread between the 10-year Treasury yields and the 10-year TIPS rate. As we notice here, the 10-year Treasury yields and the 10-year TIPS rate have been declining, but not proportionally, which has led to the spread to climb to 1.92% in December. This spread was standing at 0.5% or 0.49% in March, and has been climbing ever since. The second signal is the ratio between copper and gold prices. Reason being, copper prices have historically been correlated with expected inflation yield spread, which we discussed in the previous slide, and also gold prices have been highly correlated with the inverse of the TIPS rate, with gold being a hedge against inflation. Hence, the ratio of the prices, copper prices and gold prices, could point to the fact that looking at historical data, that the 10-year Treasury yield should be closer to 2%. But with the Fed's purchasing treasuries, they have kept the lid on the inflation rate. Finally, the last signal we're going to look at is the US dollar and its weakness against the basket of developed currencies. As seen here, the US dollar index has been negatively correlated with the price of copper in the orange, and also the US dollar index has been almost negatively correlated with the proxy for expected inflation. Therefore, with the weakening of the US dollar and given all the signals above, all variables point to the end of a deflationary pressure, which could potentially mean a rising inflation. In such a scenario, if inflations continue to climb, interest rate will rise, and as a result, the amount of debt accumulated by private and public companies during easy credit cycles lead to higher interest expenses on those debt, and the result, a credit crunch. This could potentially put the stock markets into a more difficult condition and on the verge of a bear territory.